Kim, do we have other people on? Or should I wait a moment?
Looks like we're up to about 21, Natalie,
okay.
at this point.
I couldn't see it in my view. About that.
Yeah, it's
Participants.
yeah.
Got it. All right. Well, I'll just get rolling. Good afternoon, everyone. Thank you for joining us today. My name is Natalie Wolf. I'm the Director of Investments at Foundation for the Carolinas, and on behalf of the executive leadership team at FFPC, we thank you all for joining today. If at any time during the webinar you have questions or would like further clarification on a specific topic, we invite you to post your questions in the Q&A window, and the Mercer team and or myself will address these after the presentation during the Q&A portion of the webinar. If we do not get to your question during the session, we will follow up with you after the webinar. This webinar is being recorded and the link will be added to the fftc.org website, or as I've just recently found, you can just Google FFTC investment webinar. I will now introduce you to Travis Pruitt and Tim Westrich, who lead our consulting relationship at Mercer. Travis will be leading the discussion and will address market conditions and investment performance for FFTC's investment pools during the fourth quarter of 2023. And today we have a special topic of index or passive investing versus active, and the differences. And if you are inactive and are thinking about our passive pools, or in passive and thinking about going active, I think that we'll have some great discussion around that. So I'll let Travis take it away. Thank you.
Perfect. Thanks, Natalie. Well, it's nice to be with you all again today. I hope all's well in the greater Charlotte area. So as Natalie noted, we'll briefly go through market overview. This quarter's overview will be much shorter than previous quarters. So we look forward to your feedback on how that goes. We are going to talk about active and passive management, pros and cons of the strategies, as well as how it fits into the FFTC portfolios. Then we'll review the standard tool performance. We're not going to go into the individual building blocks today, but we're going to spend more time just at the top level. And then, as always, we'd love to get your questions and interaction. So with that, let's dive in. It was a pretty darn good year. But if we start with the fourth quarter, we saw bonds rally pretty strongly in the fourth quarter as the Fed changed their messaging around expectations for further hikes. They basically came out and said they were done. And the market began to extrapolate what that meant in terms of future cuts. And so we saw in fixed income of just about all flavors, but primarily here in terms of the foundation portfolios, your largest allocation, excuse me, across the foundation is in these broad investment grade bonds as represented by the aggregate, up nearly 7% for the 3-month period, which in bond land is pretty tremendous returns. And you can see across all of these flavors of fixed income at the bottom part of the page here, really pretty good returns. That also translated into strong equity market returns, in many ways led by companies, or led by the stocks of companies that are tend to be more reliant or bigger users of financing in the support of their businesses. So companies like U.S. smaller companies, companies in the growth phase where they need capital for growth, and in real estate oriented companies or REITs, real estate investment trusts, where the cost of financing has a very direct bearing on the valuations of the underlying commercial buildings that they may own. Excuse me. So it was a really pretty tremendous quarter in terms of absolute returns that punctuated a really strong full year environment. And from a global equity perspective, so stocks around the world were up 22% for the full calendar year. As I was doing my prep for this, it reinforced the notion of how challenging things like market timing can be and why we don't do them. Half the year's return came in the final 3 months of the calendar year. And as we'll see in a second, given volatility and the changing direction that we often see in today's markets, it just reinforced for me how challenging it can be to try and move between asset classes or into cash and out of cash. Just the movements in the markets can be very violent. Stocks like bonds, all of these are very respectable returns over the course of a full 12 calendar year. But it was a reasonably narrow market from the top leadership perspective. particularly so through the first 3 quarters of the year, where the Magnificent Seven names, which you've heard us talk about before, the Apples, the Microsofts, the Nvidias, continue to perform well through the end of the fourth quarter and really helped drive that growth part of the marketplace. And in fact, even as we roll into 2024 today, 5 of those 7 names continue to provide market leadership and index leadership. And that has some ramifications in the portfolio that will be of interest actually as we talk about active and passive. So all in all, a pretty good absolute return year. Hard to be too upset with that, and a nice rebound overall after a pretty difficult 2022. But it wasn't straight up, and this sort of plays in, if you will, to my earlier comment about the challenges of market timing. Lots of things went on over the course of the year, and in some ways the year started and ended on similar momentum, but just a different magnitude. So in the first calendar quarter, and actually in the first month of the year, global stocks were up nearly 10% in January. A fair amount of speculation, very strong small cap performance. And then things like the banking crisis, distress in the banking system started, basically by the end of the quarter had eroded much of that return, only to turn around and enjoy the second quarter, marching strongly higher, even in the face of some, more challenging things like the debt ceiling and the downgrade of the government, but with an economy both in the U.S. and outside the U.S. that just refused to yield to the views that we're going in a recession. We did avoid recession over the course of the year. There were some growing concerns of that in the summer, which you can see this blue line is global stocks sold off again. But really here, mid to late October, when the Fed changed the tune, we really did see that set the stock market, the global stock market off to the races. As the yield on the 10-year Treasury dropped up 100 basis points or a full percentage point from its peak over that period, it really drove those bond market returns and drove those equity returns. If we had to look at a picture going forward, I think that the probability of more volatility like this is still pretty high. There's changing consensus often in terms of where interest rates are going. Is inflation really dealt with? Are we going to have a recession, and when? And as a result of that, the market is reacting pretty quickly and pretty violently as it did over this 12-month period. We think that that's likely the forward view. As I've said before, we think at some point we'll have a recession. Very difficult to say when that might be. And while it appears that inflation is moving in the right direction, the ability to stay in that spot at a reasonable inflationary level continues to be the Fed's #1 challenge. And we think that the commentary will continue to reinforce that. So I thought this backdrop for this year led us into our special topic actually really pretty well. Because we want to talk about active and passive management. We think that in most cases there is a role for each of active and passive within portfolio implementation. We'll talk about some pros and cons of each, and again how they get used in your portfolio. So when we're going to talk about some of the advantages of active management, but to define it, our primary objective when we seek active management, that is to hire managers that are going to pick individual securities in an attempt to outperform the benchmark, and to do that consistently enough that the active manager can deliver to organizations like yours superior returns versus a market benchmark. Now, there are 2 ways to outperform, albeit most of the time outperformance will be gauged on the ability of the manager to generate a return that is in excess of the benchmark return. But you can also take active management from a different angle, and if you generate a return that is similar to the market benchmark over time, but you take a lot less risk to get there, that is another way to do active management. That tends to be a little less common because it's just harder to measure without some extra data points, and it becomes a little less clear that the value add that you're getting from active management. But there are a couple of different ways to think about it. For our purposes today, we're going to focus primarily on long-term superior returns. So one of the opportunities or advantages that we think active management delivers is the opportunity to add some value over market benchmark. As we'll talk about in a second, not every part of the the investing universe is well suited to seek active management. There's opportunity sets in some places better than others, but we do think that there are places where active decision making, active management around a portfolio construction can add value and can add excess performance over our market benchmark. So one of the advantages of active management is the opportunity to do that. We do tend to see a fair amount of active management value, and this is particularly true in equity active management, public equity active management, is that a lot of the value is delivered as a result of in down markets. Active managers tend to have positioning differently from the benchmarks. You really need to if you hope to outperform or deliver a differentiated performance. And oftentimes that opportunity or the outperformance will sometimes be clustered depending on strategies in down markets. And then finally, just by going passive doesn't necessarily mean that you're immune to certain types of concentration in the market. And we're going to look at that more closely here in a minute. But one potential advantage of active management or blending active management with passive in a portfolio is to provide better diversification or more distinctive diversification so that you have a more diversified mix of risk factors within your portfolio. When we think about passive management, the objective of passive management is very clear. When we will pick a market benchmark, and the objective is to replicate the risk and return of that benchmark to the best as possible. Not every benchmark is able to be replicated. So benchmarks, big public liquid markets like the S&P 500 or the Russell 2000 index of small cap stocks, those are generally deep enough and liquid enough markets to replicate the benchmark return with very little tracking error or very little differences in return and risk over intermediate points in time. Other parts of the market are less liquid. High yield bonds, for example, less liquid, unique features, and some of those areas can be actually more difficult to replicate in line with the benchmark. So it's passive is not available in every part of the marketplace, and I have some examples of that in just a minute. But when we think about what the advantages of passive management are, when you go with active, you pretty much reduce your active manager risk. There is the notion, again, in some of those indices where you might not be able to get perfect replication, that you'll have some variation in return. But generally speaking, in our core passive positions, we get pretty close to the benchmark return. And that allows us to reduce active manager risk in categories where perhaps it might be more difficult to generate active management premium. Passive, because it is really just trying to replicate in most cases, a capitalization weighted benchmark, typically investment fees are much, much lower. And in some classes today, just given the size and scale of some of the biggest providers, we're able to access S&P type exposure for you for very, very low fees to be able to to deliver to you for those part of the portfolios as much of the market as possible. And then because they're trying to match mostly a cap weighted benchmark, the monitoring and oversight requirements, while still meaningful, are less than what we might do for an active management strategy that we're trying to make sure continues to deliver on its objectives. So we strongly believe that for a lot of clients or a lot of client portfolios that active and passive can and should play an important role. We do think blending them makes a lot of sense in client portfolios. But one of the advantages of the FFTC platform is you do have the range of options to have a blend of active or passive or just a passive option, and we're fully supportive of making sure that those options are available for you to be able to best align with your organizational needs. So let's talk a little bit about where the opportunities lie. So I suggested that there's a range of opportunities for active management to be able to deliver a net of fee premium return. Ultimately, if we pay for active management after paying fees, we want to be able to measure a meaningful positive impact relative to a passive alternative. Again, primarily we're going to be seeking for that active manager to generate a return in excess of that market benchmark. But if we take less risk with the manager and we get a similar return to the market benchmark, that can also be value add from a net of fee basis. The spectrum that I have here on the page shows the lesser opportunities for active management tend to be efficient markets. And so what's an efficient market? US large company stocks, so stocks like Microsoft, Apple, and the like, very difficult for stock pickers to develop an information advantage on Microsoft. Most everything that can be known about Microsoft is known by the market almost immediately as it becomes available. So there is little opportunity for the intrepid analyst to be able to add more insight on Microsoft versus what the marketplace might deliver. So we find and those stocks tend to trade immediately on information, and so there's just less opportunity in those efficient markets to be able to deliver a premium. And so those tend to, both in our views and you'll see actually across much of the marketplace, tend to have a larger passive allocation. So what might those be? So US large cap for us in your current portfolios is entirely passive and will likely be predominantly passive over time unless there's some other risk return profile we're trying to express. But realistically, it's a very difficult space to outperform in, both from our qualitative experience as well as just looking at the numbers for active large cap over time. As you look at it, if you look at it in the entirety of its history, after paying fees, it's just very difficult to get sustainable, consistent added value. Doesn't mean that some managers can't do it. Doesn't mean that some managers don't do it over various points in time. But over most rolling 3 and 5 year periods, net of fees, collectively as a group, it's just not a particularly awe-inspiring track record. So we tended to say that's generally going to be a large portion of our allocation. We want to make sure that we get the large cap component of our return from our strategic asset allocation. We're going to take that cheap market exposure or cheap market beta, and we're going to spend our active fee budget and our risk budget in other parts of the portfolio that might be more attractive. As we move out the opportunity set, we find that in certain types of bonds, so core plus bonds, which is how we have invested the primary portion of your fixed income portfolios, in addition to the short duration bonds that we have, core plus bonds are just the entirety of the investment grade universe. So governments, investment grade corporates, and mortgage-backed securities, plus some things like small amounts of high yield, emerging markets debt. We think collectively there is an opportunity to add return there. It's probably not, it does have a fair amount of efficiency, but we do think there are opportunities for active management there. And similarly in large companies outside the US, smaller and mid-sized companies inside the US and emerging markets, we think there are opportunities for active management here. They tend to be very competitive spaces, so it's not as durable as perhaps it might have been 25 years ago, but we do think that there continues to be opportunity here, and we're going to seek out opportunities for active management. As we get a little bit further away from these more common market benchmark type investments into things like high yield bonds, emerging bonds, small caps and outside the US and emerging markets, those tend to be much more inefficient markets. And so when we want to invest in them, we would tend to lean more towards a passive or an active strategy. There's just fewer players in those markets. They're much less efficient. We're really not doing any of these categories currently in your portfolios on a dedicated basis. But some of our active managers, as I mentioned in core plus bonds, for example, your active managers will own small allocations in some of these places because there is some opportunity to add value through security selection at a very reasonable level of risk. Some areas of the market are just don't have an investable benchmark, as I mentioned, or can be challenging to recreate the characteristics. And so for your diversified long-term growth portfolio, you'll recall we have a 15% target allocation to absolute return hedge funds. And we think of them as a companion funding to your core plus bonds. So they're part of our risk reducing category. There are some ways to try to replicate some of the characteristics that you can get from the strategy, but it's really not possible to go out and just buy a simple passive solution here. Active management really is the story when it comes to the hedge fund portfolios, because it is a collection of underlying managers that each have specialization in a small part of the market, and then our team puts them together for you in such a way that we get that big picture characteristic. So much harder to replicate, not impossible, but much more difficult to replicate on a passive basis. And even then you have to make some active decisions with the component parts to get that outcome. And then there are finally some areas where there just isn't an opportunity to invest passively. Places like private equity, private credit or private debt, private real estate, there are just not publicly traded passive options available in the marketplace today to deliver these classes. And that is actually part of the reason why they continue to have or offer, probably a better term, why they continue to offer the opportunity for additional return. The fact that private equity doesn't trade on a public exchange means that the actual transactions in those are inefficient. And inefficiency allows for the opportunity to make excess returns. So these are places, these are all categories that are held again in the diversified long-term growth portfolio. And part of the reason that we own them is because the ability to select and implement active managers in a category that needs to be active does provide, we think, the opportunity to generate additional excess returns. So this notion of active versus passive is not necessarily cut and dried, but I did bold here all of the places where we are currently active in your portfolio, or currently invested in across the portfolios, excuse me, for diversified long-term growth, for active long-term growth, and for the ESG long-term growth pool. Those are all a mix of active and passive strategies. And then, of course, the passive long-term growth is all passive across all of the public markets. And in fact, income growth also has some passive active blend as well. So we do think that they make sense in both portfolios for a lot of the reasons I've talked about. Just a couple of the things we wanted to hit here. First, you may have seen a chart like this, and this is the percentages are a little bit dated, but I think the story it probably remains relevant. When we talk about that notion of the Magnificent Seven and the concentration of names at the top of the popular indices, that becomes important because when those stocks at the top of the indexes perform extraordinarily well, it makes it difficult for everything else to keep up. And so as a result, we like to understand what the concentration is in the S&P, in part to be able to explain whether, if we're underperforming, does this have an impact to it? And what might we think about the future? And what does it think about diversification of portfolios? So you can see over time, I guess the two big takeaways is that while 29% of the portfolio or close to 30% of the S&P 500 concentrated in the top 10 names is the top end of the range, it is clearly not out of bounds in terms of concentration. You can see that anywhere from close to 20 to 30% of the S&P 500 over the last 6 decades has been pretty common in terms of concentration in the biggest names. But those names have changed, and they reflect a changing in market environment. They reflect an evolution of our U.S. and global economy, and we would expect, if we could look over the next 6 decades, that the names would change again. And it's one of the advantages of having a passive component within a big market leading sector like U.S. large cap is that you always have exposure to these companies that are doing the things in their businesses that are resulting in growth in sales, growth in earnings, leadership in their respective marketplaces. And as a result, they attract capital, returns go up, market prices, market values go up, and they become the weightings. I did mention, though, that just because you're passive doesn't mean that you're avoiding all types of concentration. And so, while we like the S&P 500, we think it's a great way to get U.S. large cap exposure. You're not without risk when investing in a strategy like this. And I think Apple's probably the best example. It's the single largest holding of anything on our page here over the last 6 decades, and you can see it's 7% of the portfolio. So if you're this comes back to the notion of active management in the sense that if you're actively managing a portfolio and you want to express a view that you like Apple, you have to own more than 7% of your portfolio in it to actually seek to outperform the market, because the market itself owns 7. And so those kinds of concentrations, and particularly when you look at active large cap strategies, those can be a lot harder and a lot less comfortable to own when you're investing with an active manager. If 2023 was your active manager lineup, not everyone's always going to be comfortable with that. So again, we like this exposure because the names change and yet the S&P continues to lead. So, but it's a good reminder that at times there can be some concentration risk. And so we just, along those same lines, we just took a look at the U.S. equity building block portfolio for FFTC, which is the U.S. It's the active domestic component in each of the pools, with the exception of the passive long-term growth. And we measure that against the Russell 3000, which is just a slightly broader broader context of the U.S. marketplace. And you can see that because of some of the diversification, sorry, too much coffee this morning. Because of some of the diversification that we have in the portfolio, 75% of this U.S. equity portfolio is in the S&P 500. 15% of the portfolio is in 2 active small mid managers, and currently 10% of the portfolio, I did that math right, currently 10% of the portfolio is in a lower volatility but larger cap strategy. And we are slightly underweight Apple, Microsoft, Amazon, etc., because we are more diversified than the benchmark. And so, as we'll see here in a second, that had some that caused some relative underperformance in an environment where these names really led the way. But as as markets change and evolve over time, and this leadership changes, it does create opportunities for that diversification to add excess return in addition to risk reduction. So hopefully found that helpful. I think I'd like to change gears now and then just see where we are on time and run through the standard pool performance, a little bit different format. Again, would love to get your feedback. Just as a reminder, I talked a little bit about this maybe in my earlier preamble, but you do have a range of options available to you based on both your capacity for time horizon as well as differing capacities for liquidity, and then also the appetite to accept risk. And so we have 2 shorter term, more conservative options in the form of the liquid reserves and low duration. Your FFTC platform offers you an income and growth, which is about 40% equity, 60% fixed income, all in traditional markets. And then our long-term growth portfolios are generally speaking around 75% equity, 25% or 75% equity or equity-like things, and 25% fixed income or fixed income characteristic-like things, with differing flavors. So let's talk a little bit about how those performed in this most recent environment. So as I talked about, the falling interest rates and expectations for forward rate cuts really helped our our portfolios with much more bonds and cash. So liquid reserves is our cash option, and you can see that after a number of years where cash returned virtually nothing for the full year of calendar 2023, that regime of interest rate hikes in 2022 moved the return from 1.7% in 2022 to 5% in 2023. So we've just not seen this level of cash rates for the better part of a decade, and just resetting, if you will, the cost of money, but benefiting those of you that have liquid reserve assets in the portfolio. Low duration fixed income bounced back really pretty well. We didn't talk about it today, but we talked about it at length. The interest rate curve, the yield curve is inverted, so that means that the rates for shorter stuff like cash are higher than rates for longer maturity, and so that does explain some of the relatively lower returns for the low duration fixed income versus cash, because the yield curve is still inverted. But as you recall, that raising of interest rates had a pretty negative effect in 2022, but the low duration portfolio did a nice job of bouncing back and producing premiums in 2023. Similarly, for the quarter, income and growth, which is, as I mentioned, about 40% equity, slightly underperformed our target weight index, but again, generated more than 50% of the entire calendar year return in the last three months of the quarter. And I think very competitive, given that some of the narrowness of the equity markets. Overall, pretty good implementation results from our underlying managers, just falling a little bit short of that benchmark for the calendar year, but bouncing back nicely from 2022. When we look at the long-term pools, passive did lead the way. So that narrowness in the marketplace did allow strategies that are focused on passive, where most of the capitalization exposure is up in those bigger names, Passive did outperform on an absolute basis for the year, but you can see as we just look up and down the quarters column, really pretty solid for our 3 public market only solutions, 9 to 10% returns over the course of the quarter, and over the full year, 15 to nearly 17.5, about 17.5% for the full year. So absolute return wise, really pretty happy as in the way that the portfolio has participated in the up markets. And after doing, particularly with the passive and active long-term growth, producing reasonable returns for what was a pretty significant drawdown in 2022 and getting some bounce back from that. The ESG pool, which we talked about a fair amount since its launch in late 2021, it does have given the nature of ESG, higher rated ESG strategies, it tends to do a bit better when the growth style performs better, which as we talked about, it did last year. So its absolute returns are a little bit better. But in 2022, when the growth style trailed, you can see that it actually had a bit of a lesser year. So just a slight differences in, or modest differences, if you will, in the style structures between, say, the ESG implementation and the active long-term growth, just means that while we like the managers underneath both, and we would expect over long periods of time them to both generate premiums, they will have slightly different journeys as we move forward. And then diversified long-term growth, as you recall, we have a lot less public market exposure in diversified long-term growth than in the other 3 long-term growth portfolios. And as a result, didn't participate as strongly in that market year. And in the quarter, you can see diversified was up about 6% versus 10% for the passive long-term growth, up just about 11% for the calendar year versus 16% for passive. But it's really a flip of 2022, where the same lower public market exposure helped to protect capital in the diversified long-term growth in the down market year, down only about 11%, whereas the passive long-term growth was down about 15.5%. So again, we would expect both strategies over time to provide a very reasonable return in support of your objectives, but they'll just have different pathways to getting there. And ultimately, we think that the greater level of diversification for long-term growth, as well as access to some of those asset classes like private equity, private debt, we do think that there's some potential return premium there. And over the longer brace of time, we would expect DLTG to provide a bit more return and a bit less volatility than, say, our active-only solutions. So I talked a lot. So let me pause there and see if there are questions from the field. Would love to get any input either today or for the future. And maybe I'm going to go ahead and pull down the slides, Natalie, and we can just see each other.
Sounds good. So now for any questions, go to the Q&A button on the bottom of your screen, press it, and type in your questions to us. I'll wait just a moment. Actually, I'll ask a question first, Travis. As you were talking, can you explain for our fund holders on the call generally the difference between what do you mean by public market versus private market, and which of our pools have exposure to private market versus just public?
Sure. Great question. So public markets, think of public markets it's a legal term, but public markets generally mean that the investment in a security is available to the general public. So just to regular people or to institutions, or you or I could go buy shares in Microsoft. Microsoft is a publicly traded company. Apple's a publicly traded company. Additionally, if we had the wherewithal, we could go and buy the bonds of Microsoft. Microsoft's bonds are also publicly traded. They're available to just general public investors, generally through exchanges of some type. So they have, the Microsoft trades on the New York Stock Exchange, and actually it trades on the NASDAQ. I'm not sure it trades on the NYSE. GM trades on the New York Stock Exchange. Those are all securities that are open to the average person to be able to trade publicly and access those investments. And that's true for stocks, bonds, and things like cash instruments or money market. Those are characterized, in addition to their access, they're generally traded every day. They're generally priced every day. So you have a sense in the public markets as to the transparency that's going on with the activity within those particular securities, and your ability to react to that. So I'll contrast that to privates. If you start Natalie, you're going to start my son-in-law runs a landscaping business. He started it from his garage. He's got a handful of employees. He owns 100% of the business. That business is private. If he wants to bring in other investors, if he knocks on my door and says, "Hey, we're going to expand. I could use some investment capital," I can make an investment with him in his business, but that would be on a private basis, a one-to-one basis. He couldn't go in his current business format to the market, to the New York Stock Exchange and float shares in his company because he's not registered to go private. He's doing business as a private business. And in the US, that's a very important form of business for our economy, and it actually dominates economic activity. Even though the public markets get most of the attention, there are only, Tim, help me with this, the Wilshire 5000 is about 3,500 stocks today. Is that about right? So in the US, there are only about 3,500 publicly traded companies. There's over 100,000 companies in the US that have more than 100 employees. And so the way to finance and invest in those companies is through a more private mechanism, which is what we hope to access with those private equity, the private debt, which is essentially, private debt is just essentially lending in a private market format, not dissimilar to what a bank would do. Right? A bank loan between a bank and an individual business is in many ways a private investment. We just don't think about it that way, given the history. So diversified long-term growth is the only pool today that offers anything other than public investment. So all the rest of the pools are all public investments. Diversified long-term growth has private equity, private debt, private real estate, and sort of the semi-public nature of hedge funds.
Another question here. What are the criteria for the ESG pool? Can you explain our process there?
So our primary objective here, and I think I can see it refining over time, but the two primary linchpins for selection of managers within that portfolio, I guess first, at the very top level, its long-term strategic asset allocation sits in line with the other long-term pools. So it's seen to be a companion or from a risk return perspective, comparable to the passive long-term growth, active long-term growth. When we worked with the investment committee to construct that portfolio, the two primary criteria were investment managers that in Mercer's research and rating process were rated in either ESG 1 or ESG 2. I'll come back to that in a second. And where possible to overlay or to improve the diversity, equity, and inclusion of the underlying managers and or their investment approach for the portfolio. So that would include things like, can we find those higher ESG rated managers that are firms owned by women or people of color or a classically just trying to say this so that it doesn't sound offensive. A classically disaffected group, right? Just trying to make sure that we have the broadest demographic footprint to provide avenues and access to different lines, different experiences, different sets of skill sets to go along with what might be seen as more mainstream investing. So we have those two parts, ESG and DEI. On the ESG rating, Mercer rates a lot of fund managers every year. We see a lot of fund managers that we rate a subset of those, and we rate an even smaller subset of those managers with a rating that we would deem as investable. Right? So we use a letter grade system, and an A or a B plus rating in our strategy allows us to consider investment with that manager on behalf of a client. We think those are the managers that have the highest likelihood of outperforming on a forward-looking basis. At the same time we do those letter grades, we also evaluate the level of integration of ESG factors into their investment program. And we put a 1, 2, 3, or 4 on that based on our read of their their integration. So an ESG one almost always would end up being something that is ESG or socially responsible labeled, right? So a fossil-free fund or one of the investments in, actually the largest investment in the ESG fund is the Vanguard FTSE Social Index Fund, and it's a socially screened version of US large cap stocks. So they do some screening based on ESG criteria, and that's our largest position. That's an ESG one. It's actually a very good example of an ESG one. ESG two is a firm maybe that takes ESG into significant consideration, but they don't hold themselves out to be that's of their objective. And we are seeing an increasing number of managers integrating ESG into their process, either because they see that they have that inclination that they think that the ESG factors are a thing that they should be growing towards, or they recognize that a number of ESG factors can be looked at as just another set of risk factors, whether that be things like environmental impacts and what that might cause to earnings, or reputational risk in the future, which could affect future revenues, or things like generational changes. My youngest son is very in tune with a lot of things that those that believe in ESG are in tune with, and he's a rising professional that I hope will have lots of disposable income someday, and that influences his buying patterns. And so that's a risk factor if you're thinking about the production of a particular good or service, as to how your next generation of buyers are going to see them. So in those cases, you may or may not want to feel good about what the ESG nature is, but it is a risk factor that we think it grows in importance every day in terms of just at least taking it into consideration as to how it might influence a company's business going forward.
Thanks.
Mm-hmm.
I was thinking about the beginning of last year and what we were talking about really on this call. So coming into 2023, there was a poll conducted by Bloomberg that stated 100% of economists polled predicted that there was a recession coming in 2023. I think we had both talked about the possibility as well and thought it highly likely, and it never happened.
Right.
So is it still coming? I know you can't tell the future, but what is the consensus now, and what is Mercer's thoughts as we go into this year?
I will say with tongue firmly planted in cheek that yes, we will see a recession at some point. I do think I think the jury though is still out as just exactly when it comes. Our house view is that the likelihood of seeing recession before the end of 2024, but probably closer to the end of the 2024 is still a reasonable bet, but not one that we would bet the house on. We also have a view that rate cuts likely to occur at some point in 2024. Again, more likely in our view for the back half of the year. And the market, if you've watched market activity, if you've been able to observe market activity from the back part of last year and into this year, that is a just massively moving target in terms of what the market thinks. At one point, there were 6 or 7 rate cuts in 2024 priced into in late in 2023. Those have slowly ticked back, as well as the timing of those. So our base case is seeing some rate cuts before the end of the year, some likelihood of a recession, but I think a lot of that depends on the resilience of the labor market, and employment still seems pretty strong. We are seeing tick-ups in things like credit card delinquencies, auto loan delinquencies. So some data is starting to present that tougher times might be ahead, but the economy was pretty resilient last year, and some of those key factors are still in place, at least for now. So we think it's a possibility, but again, we're not going to bet. We're not making large bets in the portfolio. Try and get out in front of it, because as 2023 demonstrated, you so eloquently captured, was just wrong, right? The whole world was wrong when it came to recession, and Had you backed off your holdings, had you gone to cash, you'd have missed an enormous return year.
Again, to our participants, any other questions, put in the Q&A box. The button's at the bottom. Another question for you. Is this the time to get out of liquid reserves or low duration and get more into the equity market in one of our long-term pools?
I'm gonna let you answer that one, Natalie. So we're firm believers that we should only do things where we think we have an edge. And as I alluded to early on, market timing is not one of those places. There are just a significantly few number of people that can get those kinds of calls accurately, consistently. So I think if you're considering your liquid reserves or low duration, whether it's the right point for you, I think the first notion to think about is what's your time horizon, right? So what's your capacity for, a portfolio that's seeking to generate a longer term return, which means it will have more short-term variability, and assess whether you can handle the periodic downsides. I mean, even from my picture of 2023, where we saw the zigzag line, it changed direction 4 times over the course of the year last year, and where ultimately at the end of the year, getting out of low duration and going into one of the longer term pools would have been a good choice if you did that on day one. But you could have second guessed yourself at any point in time and maybe changed that decision in one of those troughs. So I do think it's very difficult to make that kind of short term measure, and then to decide when you're going to pull out the checkered flag and decide if you're successful or not. So I think if you're in those shorter term pools, and you're not quite sure that's the right place to be, I think work with Natalie and members of her team to talk about your time horizon, talk about your appetite for risk, for downside. We can provide additional data to help Natalie and her team have those conversations with you. If you have a very long time horizon, you have known cash flow, you have more known cash flow structure, it does create a better opportunity to take more longer term risk. But I think that it's very individually oriented by organization or by donor.
Yes, and I'm happy to speak to each and every donor out there, really, if they're thinking of switching pools or want to ask the questions if they're in the right one. My contact information is available on the website, or email me at nwolf@fftc.org. And with that was all the questions we had.
Great.
So we can wrap it up. Thank you to everyone who joined today. Thank you to Mercer. And just a reminder, we'll be posting a recording of this webinar on my FFTC/resources as soon as possible. And hope everyone has a great rest of the week.
Thanks. Everyone. Great to be with you all again. Take care.